Okay, here's a wild thought for you. What if I said that one of the best ways for a company to save money is actually by spending it? I know, it sounds totally backward, right? But believe it or not, it's one of the most powerful tools in finance. So let's dive in and break down exactly how this works.
I mean, how can that even be possible? Paying an expense to save money? Expenses are supposed to cost you, not save you. But stick with me because by the end of this, you're going to see exactly how this one very specific type of expense pulls it off. All right, so to solve this little puzzle, we've got to start with the main ingredient, the expense at the very heart of it all, what it costs to borrow money. So, when a company needs cash, it might take out a loan or issue bonds, right? Well, that money isn't free. There's a fee for borrowing it. That fee is what we call interest expense. You can just think of it like any other bill the company has to pay, like rent for its office or salaries for its team. It's just a normal cost of doing business. Okay, let's make this super clear with a quick example. Let's say a company borrows 100,000 bucks, and the bank says, all right, the interest rate is 10% a year. Super simple math, right? That means the company's interest expense for the year is $10,000. Now, that's a real cost. It comes right out of their profits. But, and this is a big but, here's where things get really interesting. See, that $10,000 expense, it has a kind of hidden superpower, and it all comes down to taxes. This right here, this is the magic phrase. Interest expense is tax deductible. This is the one rule that flips the whole thing on its head and turns an expense into a way to save. So what does tax deductible actually mean for a company? Well, it's actually pretty straightforward. Basically, the government lets a company take all the interest it paid on its loans and subtract it from its income before the taxman comes knocking. So they end up paying taxes on a smaller amount of money. And this simple little rule creates this really powerful benefit that we call the tax shield effect. Okay, this is where you'll really see the savings in action. Let's imagine we have two companies, Company A and Company B. They're identical in every way, except for one thing. One has a loan and the other doesn't. All right, check this out. Both companies make 100 grand in profit. Now, Company A, the one with no loan, has to pay taxes on that full amount. At a 30% tax rate, that's a $30,000 tax bill. Ouch. But look at Company B. It gets to subtract its $10,000 interest expense first, so its taxable income drops to $90,000, and its tax bill only $27,000. Just look at that difference. That one deduction changed everything. That's a $3,000 difference. That is real cash the company gets to keep. And this saving actually has a cool name. It's called the tax shield, and it's a perfect name for it, right? Think about it. That $10,000 interest payment acted like a shield. It literally protected 10 grand of the company's income from getting taxed. Now, sure, the company still had to pay the interest, but because of the tax savings, the actual effective cost of that loan just got a whole lot lower. Okay, so right now, you're probably thinking, wow, companies should just borrow a ton of money to save on taxes. But hold on, it's not quite that simple. Because debt, well, it's a double-edged sword. I mean, a tax break is fantastic, but it comes with a very serious string attached. Those interest payments, they aren't optional. You have to make them no matter what. And that's the whole game right there, balance. On the one hand, you've got this awesome tax shield, which is a huge financial win. But on the other hand, a company has to make those interest payments rain or shine, whether they're having a record-breaking year or a really bad one. And if sales suddenly tank, that debt can go from being a smart financial tool to a totally crushing weight real fast. All right, let's bring it all home. Let's quickly recap what we've learned about this pretty fascinating financial balancing act. Okay, the key takeaways. Number 1, interest expense is just the cost of borrowing money. 2, its superpower is that it reduces a company's taxable income. 3, this means taxes get calculated on the profit after that interest is already taken out. And 4, and this is the big one, using debt smartly saves a company money on taxes, but too much of it can be really risky. So that leaves us with a great question to think about, right? The next time you see a company that has a lot of debt, you can ask yourself, is that a sign of risk, or is it a sign of a really smart tax strategy? And now you know the real answer isn't so simple. It's all about finding that perfect balance. Thanks for tuning in.